We're going to go through the national trends. We like to give you a lot of real data to work with so that you can make your decisions based on facts and not on guts and intuition. Not going to make any claims about investment income or anything else. You don't want to make any investment decisions based directly off of what we provide here. You want to integrate with your CPA, your financial planner, and all the rest of your financial team. Okay, with all that out of the way, I'm not going to go through all 126 slides. You should be able to get a copy of all these if you want to look at them later. So consumer confidence, we saw that last month in April, and now we've got the May data out. Saw some of the worst consumer confidence numbers that we'd seen in really about 25 years. And fortunately, the terror over all of the negative headlines about the tariffs and inflation, consumers are starting to feel a little bit less tense, and consumer confidence has come up a lot. So I'm really, really encouraged to see this. It's hard for people to get excited about buying a house, buying a car, or launching a big renovation project if they're worried the economy is about to crash and burn. So really good news here. So looking at selling conditions for houses, that is still a little bit on the negative side, but I just saw this morning. I didn't get a chance to update this chart, but when you take a look at the buy side on the right-hand side, the new data came out this morning and it came up several steps. So people are not as pessimistic about buying houses as they were last month. So that's hopefully going to help us maybe get some sales this fall that we didn't have this spring, because the spring sale season was a little bit on the slow side this year. Joe, are you seeing any pickup in inquiries on loans?
We are. Yeah, we've been swamped probably the last 2 weeks, which is a great problem to have. Yeah.
So that might correlate kind of with the home buyer confidence rebounding a little bit finally.
I think so.
Excellent. Glad to hear that. So here's what's actually happening with inflation. Inflation is actually doing pretty well, and you see the April number there, 2.6. The April number was April's 2.6. May was also pretty tame, and the predictions for June are good. So there is actually good news so far on inflation. Unemployment has been pretty steady despite all the government layoffs. So a lot of things in the economy are actually going pretty well right now, despite the fact that no one seems to think so
Yeah.
among the consumers that are out there.
There's an awful lot of negative headlines, but when you look at the real data, things are going pretty good.
Yeah, it's actually not too bad. So if you ask a bunch of economists, are we going to sell more houses this year than last year? The consensus, everyone thinks we're going to sell about 10% more homes. I would be really happy if we sold the same number of homes as last year, or if we had a tiny increase, that'd be amazing. I think there's a small chance we might actually have a small decline in the home sales. Joe, what's kind of your take on that?
This 5.1 that's in green on the far right, I don't see it. I think we're going to be closer to 4.5, 4.6. I think it's going to be very similar to 2024. And my reasoning for that is the spring selling season was very apathetic, very lackadaisical as compared to normal springs. We're now getting into the little bit of the summer doldrums, which anybody on this call who's been through a real estate summer, the prevailing sentiment is the summer is actually really busy, but in reality, summer from about June 15th until about August 1st is a little bit of the doldrums. But the weird thing, we're seeing activity pick up. So, for a number of years, we've seen the spring selling season inching forward. And I wonder if this year the spring selling season is going to be the late summer and fall selling season. But 5.1 million sales this year, I don't see it.
I struggle to see it. I think we're going to probably continue to see consumer confidence improve over the next couple of months from the really terrible levels that we were at. So it wouldn't surprise me actually if we have a fairly decent summer, which would be really nice.
Do you guys know where we might be? Do you guys know where we might be so far in 2025?
I think we're
about half of that 5 point.
I think we're off a couple percentage points from last year's pace. So I think if we continued the year at the pace we're at right now, it'd probably be what, Joe, 4.4, 4.5?
Yeah, 4.4, 4.5 million sales. The 5.1, I would love it. I don't think that's going to happen. Nick, I think that's a great question. I think we're trending lower from the 4.6 million sales on this chart last year.
Yeah, I do think, as Joe said, the back half of the year will be up a little bit for all the reasons he talked about. So we'll fill in a little bit of the hole, but nowhere close to that.
Yeah.
Affordability on the right-hand side, you can see is at a real low point right now. The lowest it's been probably in about 20 years, and that's probably not going to change anytime soon. If you ask consumers, do you think that your income after inflation is going to grow very much over the next 5 years? Most consumers think no. So that can become almost a self-fulfilling prophecy after a while, unfortunately.
Yep.
Do you want to talk a little bit about renters struggling economically, Joe? What do you see with the first-time buyers who are applying for mortgages with you these days?
Yeah. So the left-hand chart there, where you've got consumers with unpaid bills, what you'll notice there is renters have a lot more unpaid bills than homeowners do. And we're going to talk about this a little bit more when we get to as there's going to be a foreclosure crisis. I don't know if we'll have time for those slides or not tonight, but we're seeing some renters that call and they're just saying, man, it's time for me to buy a home, and we'll go through some of their stuff, and they've got a late car payment or they've got some late credit cards. So we are seeing a little bit more pressure, if you will, on the system for folks that are just struggling to keep up with inflation and struggling to keep up with just day-to-day cost of living. So I think that slide on the left-hand side really shows that in the gray bar at the very bottom, more than 25% of tenants have struggled to pay at least one bill in the last month. Yet homeowners, only 10% have struggled to pay at least one bill. So I think the affordability, along with just the cost of everything, has gone up. It's a little bit tough.
Do you think this is why we're seeing credit card balances increasing at such a rapid pace right now, faster than inflation?
Oh man, yes. I could go down a very long, deep rabbit hole on credit card balance. Yeah, I'll just give you a quick summary. Fourth quarter, consumer spending was $202 billion in the fourth quarter. Consumer debt increased $212 billion in the fourth quarter. And that means that
Wow.
100% of consumer spending in the fourth quarter was financed.
No.
Plus one.
Wow.
Yeah,
Wow.
that's a scary number.
That's incredible.
So it's interesting, Joe, in the finance, I'm guessing, now you can buy a computer on Amazon and buy now, pay later, and pay over 2 years. I'm sure that's all factored into the finance numbers that you just mentioned. So very interesting.
Yeah. And I mean, I think it's scary. I mean, I saw one the other day at the airport that you could buy snacks at the airport and buy now, pay later. I'm like, oh my God, I'm gonna finance a candy bar and a bottle of water.
Yeah.
But some folks do it because things are tight out there.
It's
That's
really deeply
really tight.
concerning, because now it makes the very expensive items seem much more achievable, right? I can go buy the $3,000 computer, the $5,000 VR headset, or something like that. All I got to do is pay $10 for the next 10 years of my life, right? And you can do that now. So it is concerning. I mean, I think it's going to keep putting people more and more, unfortunately, in the red with that kind of behavior.
Yep.
We have a question from Matthew. All adults is not the mean of homeowner and renter on this right chart?
Yeah, it's a weighted average. So if you take the homeowner score times about 65%, because 65% of households are owned, and then 35% times the renters, because that's about the percentage that are rentals, that should get you to the blended of all adults.
Mm-hmm.
Good question. I'm glad that you asked that. Oh, here's our credit card slide, so you can see this run up.
No, there it is. Yeah.
Wow.
Yeah. I mean, credit card debt is just increasing. There's more credit card debt now than there has ever been in the history of the United States. And sooner or later, Chase, Capital One, American Express, Bank of America, they're going to stop increasing limits. And that's going to lead to a point of reckoning that I think will actually be a good thing, because a lot of people that are homeowners are going to have to take out second mortgages, are going to have to take out cash out refinances, are going to have to sell their home. And that's going to loosen up some of the golden handcuffs, which I think we've got a slide in here. But that gray line that's going up so sharply since first quarter of 2021, that is inflation and consumer debt or consumer spending being added to credit cards.
And you can see how that coincides with the sharp decline of the savings rate here. I mean, first quarter of 22, I mean, we're at some of our lowest savings rates we've been in the last 20, 25 years.
Yeah, since
Yeah.
basically,
Yeah.
if you go back and look at the global financial crisis from 2006 to 2008, our savings rates are back to
Mm.
very similar to those years, and those
Yep.
were hard years.
So, sort of connecting the dots here, I really struggle to see that with affordability being a challenge for first-time buyers, that we're going to see a lot of renters migrate to becoming homeowners. I think a lot of people are going to be structurally trapped as renters for much longer than they ever anticipated, perhaps through their entire lives. So,
Mhm.
for the people that are landlords, you've got a lot of tailwinds pushing you demographically based on all this. Do you want to talk about delinquencies and what you're seeing in real life there, Joe, and how these charts might link to that?
Yeah, so I'm not a great data point for this. I see these charts, and we certainly see, credit card delinquencies, 12% are 90 days delinquent. Auto loans,
Mm.
5% are delinquent. Student loans, 8% are delinquent. I personally don't experience this because a lot of the folks that I talk to are, homeowners or potential homeowners. I did, touch a few slides ago that sometimes we do see some renters that are struggling. I don't see a lot of folks that are 90 days down, because by the time they're 90 days down, they're probably not calling a guy like me.
They're not
Um,
bankable.
yeah, they're having other issues.
Homelessness might be their next step.
Yeah, they're not thinking about buying a home. But we do see more lates, and I would say not necessarily more lates, more higher balances. So I can tell you, 2 slides ago on the credit card balances, I really have a keen view into that on a day-to-day basis.
We had a question from Jorge. So speaking of loosening up the golden handcuffs, supply has definitely increased over the last 2 years, but buyers have decreased. Any thoughts on this trend?
Well, I think the decrease in buyers is all the things that we just talked about. And then for this increase in supply, the supply of inventory right now is still less than the average pre-COVID of, say, 2017, 2018, and 2019. But we had to eventually, start to get our inventory back up to what the historical level had been. So I think we're still like 10 or 15% below. So I wouldn't be surprised if you see inventory go up another at least 10 to 20% over the next year. And then we'll be at pre-COVID levels. And then that's kind of like normal. What we've really suffered through, and suffer is really the operant word, over the last 4.5 years, is like dysfunctionally low inventory. So I'm very grateful to see us get to a more fair fight between buyers and sellers instead of having it being so one-sided in the favor of the
Mhm.
seller all the time. Great
Mhm.
question. I'm going to skip some of the slides that we've covered a couple times over the last few months and focus on some of the newer ones. This is a new slide I hadn't seen until recently. If you ask Americans what is the best long-term investment, real estate is still the number one choice by far. So I do find encouragement out of this slide here. Okay, our price is going to drop. So my thinking on this has actually evolved a little bit over the last couple months. So 70% of Americans are concerned about a potential housing market crash. So when I think of market crash, I think of 2007, 8, and 9, where the average home price in the Denver metro area dropped by about 25%. I don't think there's any chance of that. But I do think that my thinking has shifted from prices being stable to maybe prices having a slight decline over the next 2 years, probably.
Mhm.
But this negativity is very much related to the failure of consumer confidence that we opened our discussion with today. And now that we're seeing people being a little bit less concerned about inflation, they're a little bit less negative about the future. Hopefully, if you were to poll people today, it wouldn't be quite as grim as this headline here, which is, really, that's like a bummer. So, sellers are a little bit slow to embrace this new market reality. So, getting to Jorge's point, this is part of the reason why the inventories are building so much. If you ask sellers, do you think that you're going to get more than your asking price? 35% say yes. I know the whole market's having a tough time, but my house is special and feel bad for everybody else, but I'm going to be just fine. 46% think they're going to get the asking price, and only 13% think they'll have to sell their house for less than the asking price. So that's their expectations. The reality, of course, is much, much, much different than that. And when you take a look at what actually happens with pricing when these houses come to market, about 2/3 do actually sell without a price adjustment. They usually have a discount, but not a price drop. And about 35% require at least a price drop to be able to get a buyer to finally come and take over the house.
Can I pause you on this real
Yeah.
quick? The pricing requirements on the far right-hand side where there's no price cuts, 65% of the time, the home sells with no price cuts. I think that's just a testament to our real estate agents that are on the call and the folks that we work with every day. They're doing a really good job of informing the sellers. Hey, I know you want to list this at the top of the market. It's not going to sell. List it at an appropriate price, and 65% of the time they're getting that list price. Or again, there may be a discount, but they're not having to reduce the list price. So I think for real estate agents on the call, keep it up. You're doing a great job. And I know those conversations are painful when you're pricing the property, but 65% of the time you're hitting it right on the money. And I think that's a pretty cool stat.
Yeah, it's fantastic. It's probably as good as you could realistically hope for, given the dysfunctionalities that we have in the market right now. So if you're going on a listing appointment, I think this is a really great chart to bring along.
Yeah.
So what's happening to expireds? So what's happening, if you take a look at the sample period of May of 24 through April of 25, that 12-month period, of all the expireds during that period, about 38% eventually did get relisted. And when they got relisted, they sold the second time about 70% of the time. So the question is, did they sell at a higher price, the same price, or a lower price? And the answer is 68% of the time they sold at a lower price than the initial ask the first time they went out the door. It's astonishing to me that people listed their house, it didn't sell, and they bring it to market 6 or 8 months later and think, we're going to list it at a higher price. I'm not sure where that logic came from, but 6% of the time the strategy works, and 94% of the time it doesn't work. So if you guys are looking for more listings, expireds are actually a very good prospect for you, because if it's priced accurately, you've got a very good shot at getting that thing to sell. Okay. So economists think that our chance of a recession is about 35% for this year. So pretty good odds that we're not going to have a recession. I think there's a common misperception that during a recession that prices for real estate decline. And if you take a look at our last 6 recessions, the reality is that prices went up in 4 out of 6 and they only went down in 2. And 2007 and 2008, the recession was caused by the real estate market crash. So I don't think that's really even fair to have that in there. So I think the main takeaway from this is that you should expect that prices will be stable or slightly increasing in a recession based on historical precedent. And Joe, can you tell us, like, what does a recession mean for mortgage rates?
Yeah, it means that as you come out of the recession, interest rates will go down. And I love this chart on the right-hand side. As you come out of a recession, interest rates go down. Now, here's the problem. We're at 7%. If interest rates go down by 1%, okay, we're back at 6, but some buyers are still asking me. I had somebody ask me today, when do I think rates are going to get back to 3%? And I said, ma'am, I think that's a really great question. I don't think we're going to get back to that unless somebody eats another bat in China. So don't make your long-term plans on waiting for rates to go to 3%. If rates go to 6%, let's drink champagne and buy some houses.
Yep, exactly. That's about as good as we could realistically probably hope for.
Yep.
I've talked about these slides in the past. So overall, it's taking about 5 days longer to sell a house in the US this year versus last year. So if you've got prospective sellers that are saying it's a terrible time to sell, it's a bit of a challenge. But the reality is we're still going to sell over 4 million houses this year. So a lot of people are still getting their houses to go.
That's right.
What's happening to pricing? So the chart on the left is an index called Case Shiller. And you can see that based on their index. So Case Shiller is based on what they estimate the value is of every house and condo in the market, not just the ones that sold, that the realtors are thinking about in any given time period. And you can see they think that there was a very slight drop in the most recent time period, which I believe was March. If you take a look on the right-hand side, this is a different index. This one I think is some sort of Fannie Mae composite. It shows that prices were relatively flat. Between the two, they're pretty much the same answer. They're never exactly the same. But
one point on
go
that
ahead.
one.
Yeah.
I think we're going to see prices going down in condos. I think we might, HOAs are having a tough time. Insurance is tough on condos. I think you might see single families remain relatively stable, 0% growth, maybe 1% growth. But condos, I do think you might see 3, 5, maybe even 7% decline in values. You average those two together as a market, it might be down 2, 3%. But I think it's really going to be hyper local issue, and we've known this from prior presentations. Certain neighborhoods, even in the great financial crisis, it did not experience price reductions. So I think it's going to be really product dependent, on what might see declines in prices.
Joe, would you say the same thing about, for example, attached townhome housing product? Would that fall into that same category, or would you separate that out?
That depends on the HOA. If the HOA is in
Okay.
good shape, and generally, you can't see me doing air quotes, generally townhome HOAs are a little bit better than condo HOAs.
They're a lot
But
lighter.
yeah, they're
Yeah.
lighter. They're just a little bit easier. So, I guess if you put me on the spot, I think home prices are going to go up 1 to 2%. Townhomes might go down 1 to 3%, and condos might go down 4 to 6. So to directly answer your question, I think you're going to see a little softening in townhomes, but it's not going to be as bad as condos.
Got it.
So if you think about the drivers, who's your buyer set for typical condos? So you might be like in a really fancy condo downtown in a high rise. That's going to be kind of a luxury market, but the majority of condos are first time buyers, or if they're really low price, they might be really great for an investor. So right now it's very difficult in a lot of markets for an investor to buy a condo and get it to cash flow given how high the HOA and taxes are. So that part of the market's a lot smaller than it has been historically. So otherwise, you're pretty much relying on first-time buyers, and we just talked about all the different challenges that the first-time buyers are having. So the buyer pool is smaller now for first-time buyer condos than it normally is, and there's structural headwinds that I think are going to keep that buyer pool small for the foreseeable future. Meanwhile, on the supply side, we're seeing that growth in condo supply has increased quite a bit. So what this means is to have price discovery in a market, we need to sort out the sellers and find out who's the most motivated. They're going to have the largest price reductions. They're going to be the ones who are going to sell, and everyone else is just going to linger on the market. And inventories are going to build. So I think this is the root of why I think condo prices are likely to decline, as Joe just mentioned. I don't think there's going to be any buoyancy to provide a lot of price support to condos until they probably drop, at least another 5%, if not a little more, as you talked about. And Jorge just said that downtown Denver condos have about a year of inventory right now. I'm not surprised by that. There's probably a whole litany of factors for downtown Denver, plus a lot of other downtown metros across the U.S.
Yeah.
No doubt about that. So we talked about stale inventory is increasing. We talked about Denver. We didn't talk about this.
Holy cow! This chart, man, I might have a epileptic seizure trying to read this.
Yeah, so if you take a look at the change in inventory for homes on the market, Denver's had more inventory build than really any other large metro in the U.S. The gray line sort of just below Los Angeles, that's the national. So it's not something I'm proud to be leading in by any means.
But Lon, can I pause you for a minute? If we were to go back and look, there's kind of this prevailing sentiment that Denver often enters housing cycles sooner and then exits housing cycles sooner. That's an anecdotal statement. Do you have any data for that? That, hey, we might build inventory faster than anyone else, but we might come out of this on the other side faster than anyone else, or before anyone else. Do you agree or disagree with that?
Well, it was definitely very, very true in 2007, 8, and 9 during the great financial crisis, because the speed of the foreclosure process in Colorado is much, much faster and easier than it is in most states. So when everybody simultaneously got behind on their loans, in New York State, it might have taken like a year and a half to go through the whole foreclosure process. So New York, you saw the prices tip over much later than Colorado, because Colorado had a very expedient foreclosure process. And since we bottomed out, we were climbing out of the mess way ahead of, say, for example, New York, because they just delayed theirs so much, just the way structurally they're set up there. With the situation we're in right now, we're not experiencing a lot of foreclosures, and we'll probably show 1 or 2 slides to that. So I'm not exactly sure why we're seeing more of this than anybody else. We had a large run up in prices relative to the US. So did Austin, and you see they're right there with us.
Yeah.
But New Orleans, I'd be kind of, I can't think of any logical reason why they'd be so high up on the list.
Yeah.
Looking at Chicago, that's a very stable market. So them being at the bottom of the stack, that doesn't surprise me at all. So I think some of it might just be, was the appreciation in that market over the last 5 years a lot more or less than the average? That probably explains a lot of this.
Makes sense.
That's just a guess. I'm just making shit up. Joe, what is this chart telling us?
Yeah. So this one, this 25% line right in the middle is, in an ideal world, you never want to spend more than 25% of your monthly income on your monthly mortgage and other debts. And you can see in January of 2013, that was the peak of affordability. Now it's at the bottom of the chart, but bottom is better for affordability. That's when home prices were low. There was lots of foreclosures you could buy. That is right when we were shifting to really a strong seller's market, and homes were very affordable right then. You see that begins to climb up until about 2018. Then in 2021, we all have 2% mortgage rates. Homes are super affordable. Well, what's happened since that time? Home prices have ballooned as well as interest rates have ballooned. And so now over to the far right, 27.3% is the average amount that a person has to spend in order to afford their mortgage payment. So if you think that, hey, you make $10,000 a month, you're going to spend on average $2,730 per month to afford your mortgage. You probably can still afford it, but you might not be going out to eat as often. You might not be going skiing as often. So this is part of what puts a little bit of a damper on consumer confidence all the way back from our second or third slide. Is it just takes a little bit more out of your monthly paycheck to afford a home right now.
Mhm.
That's probably part of why we're seeing credit card balances increase too.
Yeah. Yep.
This is an interesting chart. The average household income needed by state. You see, Colorado is relatively close to the top of the stack,
Mm-hmm.
and the guys in Louisiana, 79 grand.
Wow.
It's cheap houses. West Virginia, I guess, is the cheapest, 71,000. So will there be a foreclosure boom? Let's just do one or two slides out of this, because we talk about this pretty much every time. I think this chart will probably get it, what we need. Joe, do you want to kind of give us a briefing on this one?
Yeah, I love this chart. First off, on the far right-hand side, 38% of homes in the United States do not have a mortgage. So that's 38% of homes that you cannot even go to foreclosure because they're free and clear. And then in the orange, 33% of homes have a mortgage with greater than 50% of equity in those homes. So if I've got a $500,000 home and a $250,000 mortgage, and I fall on hard times and I'm having trouble making my payment, I am not just going to give that house back to the bank and lose my 250 grand of equity. I'm going to call one of the real estate agents on this call and say, hey, please help me sell my home as soon as possible and get my equity out of this. Now, 28.7% of homes do have a mortgage with, I think I said that backwards, do have a mortgage that they have less than 50% equity. So there's some homes that don't have a ton of equity, but look over on the far left. All right. We've got more equity now than we have ever had. And if you look back to that gray line, that was the great financial crisis. And you see in the aftermath of that, as a nation, we were actually upside down with more debt than equity. Look how much equity we have right now. Is it possible there's going to be one home or two homes or five homes that are upside down and are going to go to foreclosure? Yes. But is there going to be a massive wave of foreclosures? No, because that happens over there where you have more debt than equity. So is there going to be a foreclosure crisis that's going to lead to 25% price reductions or value reductions? No, there's not. There's just too much equity. And if people need to tap into it, they're going to call a real estate agent and sell the house.
I think the most likely use case for foreclosure in the next 12 to 18 months is going to be the guy that bought a house at the peak in, say, 2021.
Yep.
Or the first part of 22, which was definitely the peaking in pricing. And they may have done like a VA loan or an FHA loan with 0 or 5% down. And if they bought a condo, that value might be 7 or 8% less than what it was when they purchased it. So they're actually upside down before any transaction costs. Those are the only people realistically I could think of being in a foreclosure scenario. But is there any other groups other than that, Joe?
I think you're exactly right. I mean, anybody that bought a home from 2019 or before has a ton of equity unless they've done a cash out refinance. But even if they did do a cash out refinance, they still have at least 20% equity. So, if you're working foreclosure lists, as an example, like what Lon just said, I would look at homes that were purchased in late 21 to mid of 22. That's going to be where you might find some pockets of folks that are upside down, but that's not going to be a huge number, which is a different slide because unemployment is pretty low. Lots of folks have jobs and lots of folks are making their payments.
I think the expired list is the way to go right now.
Yeah.
Let's see. Are mortgage rates going to go up or down? So where are we at with rates, Joe?
This chart is really accurate right now. Right at 6.89 is the average for the last 2 weeks. And you'll see it's been going up since, I don't know, the beginning part of this year. But I think we all need to embrace that interest rates are going to be roughly 7% for the foreseeable future. If you're hoping for rates to get back to 6%, not likely to happen. If you're hoping for rates to get back to 3%, really not likely to happen. I don't think there's going to be any breakouts that are going to move this to 8%. I don't think there's going to be any breakouts that are going to move it to 5. I think if you're a real estate investor or coaching your investor or primary residence buyers, prep them for somewhere between 6.5 and 7.5. And that's going to be the range we'll be in for the next 12 months.
Isn't it just a little bit amazing? We've got a pretty active war in the Middle East, and Iran is the 4th biggest producer of oil, and yet it doesn't seem to be impacting rates at all.
Yeah. Yeah. There was a time when something like that, we would have seen a massive swing in interest rates. There was not even one blip on the radar about interest rates today.
I was just shocked, like how we've somehow managed to get away with that.
Yeah.
All right. I want to talk about historically, these rates are not so bad.
Yeah, absolutely. Historically over the last 50 years, the average 30-year fixed has been 7.75. Currently, we're right at that 6.89%. So we're still almost a full 1% below the historical average. But what I will tell you is folks that came of age in the 2000s or the 2010s, they probably don't remember 8, 12, 8% interest rates from their childhood. So it can be sticker shock. First-time home buyers that are, 25 to 35 years old, they're really hoping for 4%, and it falls on us and the agents on this call. We have to educate them that, hey, a 7% interest rate is the reality to help you buy. And owning your own, piece of ground and your own home can still be really, really beneficial. There were people that bought homes in the 1980s with a 12% interest rate and made a lot of money. So buying a home at a 7% interest rate, you hold that home for a long period of time, you're likely to make a lot of money. But we might have to talk to them about, hey, I know you really want to buy a $700,000 home. You can only qualify for $400,000. Let's talk about what that starter home or starter condo looks like. But historically, this is, quote, not that bad.
Yeah. Somebody's got to go buy a condo. May as well be you.
Yeah, that's right.
Do increasing rates impact the market? Well, historically speaking, when mortgage rates go up, the pace of home price appreciation slows down, and usually the number of solds goes down a little bit too, and we have certainly seen that in spades. So for those of you guys on the call who are based in Denver, you can see that home price appreciation last year was about 1.5%. Not too far off from the overall average, because the average was 3.9. It's a little bit less than normal. So increasing mortgage rates also have an impact of increasing the seller concessions. So you can see Denver is having about 60% of the homes need some sort of price concession to get the sale to go through. So the initial asking price is sticking for most people. I think they're coaching to get to the right asking price.
Yep.
But the majority of them will require some sort of a discount. So no surprise there. The U.S. average is like 45%, so Denver's a little bit more than average. So for those of you guys going on a listing presentation, this might be a nice chart just to document setting the expectations with the seller. What's the negotiation price going to be like? Am I going to get my full ask price? Like, not likely unless you've got a special house in a special area, which of course you do.
I was going to say they're all special. Didn't you see the bird feeder in the backyard?
I've got a new hot water heater, so that's going to count for something, right? Okay, NAR sales pending index. So I believe the May data on this was on the same trend line of being just a little bit below 24. So when we were talking earlier about how the spring sales season has been a little bit lackluster, it hasn't really been any better than it was last year. I hope we'll see an uptick on that coming forward, because Joe's getting all these mortgage applications right now.
Yeah, hopefully.
And speaking of which, I think we've got a chart here about just that. This one. Do you want to talk about this page?
Yeah. So on the left-hand side, you've got purchase applications, and that dark blue line on the bottom left, that is how many applications or how many folks applied for a new mortgage. And then on the right-hand chart, there's kind of a dark brown line at the bottom. That is how many loans had an interest rate lock in the last week. And so the leading indicator is that blue line on the left. And so you see that right after Memorial Day, we see that little bit of a peak. And that's exactly what we've been seeing for the last 2 weeks. Or I'm sorry, that little bit of an increase. That's what we've been seeing for the last 2 weeks is we are seeing buyer activity pick up. And then over on the right-hand side, trailing by about 30 days is when you lock in your interest rate. So you get pre-approved, you go out, you look at properties, you get one under contract, then you lock that interest rate. And so these are positive signs. We're nowhere near, the averages that you see back from 16, 17, 18, certainly not the 20 and 21 years, but we're improving above 23 and 24, which I think is a good sign.
Yeah, and we're digging our way out of the pit, which is really encouraging. So much earlier, Joe was talking about how he's optimistic the summer season is going to be a little bit better than a normal summer because our spring was kind of lackluster. When I look at these two slides, I think it really supports that hypothesis.
Thanks. I'm just making stuff up too. I'm glad you had the slides to cover me.
And you're saying an uptick on the refis, it sounds like too. Is it driven by people who've got a lot of credit card debt that they're kind of running out of options and tapping
Cash
them
out.
home?
100%. I don't see anybody calling me and saying, "Hey, Joe, I've got a 2% rate. I really want to refinance that to 7%." 100% of our refinance applications are cash out. Joe, I need 50 grand, 100 grand in some cases, 400 grand for one gentleman I'm working with. Absolutely, it is all driven by cash out.
And will they spend it all within like a year and a half, 2 years?
I suspect that's the case, but some of my guys are really thoughtful that they say, "Hey, I'll give you guys a real good one. I have somebody who's taking several $100,000 cash out to buy another investment property." I think that's a great decision. But if you're taking money out to buy a boat, I can help you with that, but we might have like a long conversation to make sure that's what you want to do.
Right. Right. Can you talk a little bit about the rejected trend on the refinances being on the uptick?
Yeah. So this one is really interesting to me. We are absolutely seeing, well, let me rephrase. I'm not personally seeing more clients turn down, but the stats show there are more clients turned down. And interestingly enough, I have had multiple clients come to me that they've been turned down by, what I would describe as a large big box lender. We see their ads all over TV. And one client came to me, he had a 804 credit score. He was looking to take cash out of his home up to only 50% loan to value. And he was turned down by one of the major lenders. Yeah. And he called me and said, "Joe, I don't understand. I don't know why I was turned down." I looked at it and we had him approved and closed 10 days later. So I think there's some inexperience. Maybe there have been a lot of people that have gotten into the mortgage business over the last 5 years that are maybe just not certain how to deal with some of the factors in the market, not certain how to deal with higher interest rates. And so I don't necessarily think it's lower credit quality of these people that are applying. I think it's maybe inexperience of some folks in the mortgage business.
Makes a ton of sense. So I think Imelda's got a question. Do you see more people in the Denver area choosing to rent versus buy? Yes, we had a chart earlier that was for the national index, and you saw the percentage of homeowners is declining a little bit. And I don't have a chart to prove that, but everything I can think of tells me that it's very true in Denver as well, unfortunately. So showing traffic has been soft this year. If you take a look at the pink line, that's the number of showings per active listing per month. You can see that we're trailing 24 and 23. So the actual number of composite total showings is actually up a little bit from 24, but we have a much larger base of inventory to spread those around. So if you're going on a listing appointment, you definitely want to show this chart and coach the seller that, if we can generate 6 showings per month, that would be typical in the market. So unfortunately, like every showing counts. You got to be really parade ready to the extent that you can be, because there won't be a lot of extra showings. So I think it was Jorge earlier was talking about inventory is building. So the brown line that's increasing at a pretty good clip this year, that's this year's inventory. So if you compare that to the 3 lines above, that's the pre-COVID. This is what I think of sort of like baseline normal, 17 through 19. And we're closing the gap. If you take a look at the overheated years of the market, we have a lot more inventory than we had in, say, 2021, which was bottom dead center. And thank God, because that was a very difficult time to get any deals done at all. So I'm not too worried about the inventory build, but given the lack of buyer demand, with the increase in inventory, it means that we probably will have pricing softness, which we've talked about in length. Joe, anything else on that one?
Nope, I think you hit it.
Got it. So something important to know is that the inventory build is highly regionalized. So if you take a look in the northeastern US, we're not seeing the huge increase in inventory. So I talked briefly about how Chicago, for example, is a northwestern market, or a northeastern central middle. Chicago is a midwestern market, and they're not seeing a large increase in inventory. And why is that? Because Chicago's prices have been very stable over the last 5 years. Now, if you take a look at where are we seeing a large increase in inventory, you're seeing Austin, San Francisco, Seattle, Tampa, Dallas, all areas that have been on fire. So those markets that have had a lot of price gains, it's a lot easier for a developer to be able. Hey, Nick, can you try to figure out which person we need to mute?
Oh yeah.
They're cleaning out their garage or something, I guess. If you're like, let's say Seattle or Denver, or we'll pick Dallas. If the prices have been going up a lot, it's a lot easier as a developer to go to a bank and say, I'd like to get a construction loan to put up a new 100-unit subdivision, or I want to build a new condo building. Not in Denver, but in the other two markets, that would be easy to do. Denver's tough to build a condo. No one wants to do that. So if you take a look at the lower right-hand chart, this is just a correlation between the rate of new construction additions in the market, and then the up and down axis is talking about how has the amount of active listings increased. And you see what there is, there's a pretty positive correlation that the more construction activity there's been in the market, the more the inventory build has been. Well, it's like a blinding glimpse of the obvious, but sometimes it's good to have a chart to be able to prove that. So if you look at that lower right-hand chart, all the way on the right-hand upper, you'll see a dot for Austin, which is sort of the poster child of overbuilding excess and a ton of new construction that has resulted in a large amount of inventory gains, and it's probably going to lead to softer prices. Denver has had even more inventory build, which we talked about on an earlier slide. We haven't had quite as much new construction as Austin per capita, but we still had our fair share. If you take a look in the lower left, you can see like Hartford, Connecticut, almost no new construction activity and almost no increase in the inventory. So this just shows you probably what's going to happen with pricing. All these guys who are in the upper right, where we are building too much relative to demand, and we are increasing the inventory, those will be the markets that will have the softest pricing or the most likelihood of prices going down. Looking in the lower right, so like, Hartford or Chicago would be great examples. Not a lot of new construction, not a lot of inventory build. Prices will be firm or very, very gently increasing. The prices will be more resilient in a market like that. So this gives you a lot of advice as to where to think about making investment decisions on sort of like a national wide scope. Any questions on that?
Makes sense to me. Looks good.
It's a
Yep,
good chart.
no questions.
I really like that one quite a bit. Here's a chart. I don't know if we talked about this last time or not. If you take a look on the left-hand side, hail damage, it's a kind of a race to the bottom between us and Iowa. I wouldn't have thought Iowa would have been our competitor on this, of who has the most hail losses, but we're way up near the top of the chart, and that's a big part why Colorado insurance prices have been up at such a dramatic pace over the last couple of years.
Yeah, hail and wildfire, and we're seeing everybody get hit with insurance premium increases. One of my clients called me right before this phone call, and her insurance went up by $400 a month with their renewal. Yeah, and she's in a regular, suburban home in Aurora, and she's like, Joe, is there anything I can do? I was like, yeah, let me have you call a few different insurance companies, because that just seems astronomical.
Wow.
Was she able to find somebody cheaper, or was that pretty consistent across the board?
This was a literal 1 hour ago. She called me at 5:45. So I gave her a couple of names, and I'll find out in the next couple of days. We can talk about it on the next call, actually.
Okay.
Yeah.
So as a result of all this, on average, people are staying in their homes a lot longer than they used to. From 6 years to 9 years, that's a gigantic demographic sort of a shift.
Yeah.
So I think that's the main things I wanted to talk about. Last time we really focused on the rental market and apartments. So I wanted to try to talk about the other slides this time. And next time we talk, I may or may not have the big apartment updates yet. So we may have to wait till August to be able to do our next big refresh on that. So let's do Q&A for about 10 minutes here.
We got a good question from Jorge. Do we know if these insurance increases are more weighted towards condos or across the board for all property types?
Joe, you probably have better data on that than I do, looking at insurance level data on a file basis. What do you see?
Yeah, I don't have anything that I can truly say it's one or the other. What I can say is everybody I talk to has higher insurance. The one thing I would say that's not really increasing would be condo interior policies. So just the HO6, the inside of the unit, because that's not really affected by roofing material or hail damage or anything like that. I don't see any major increases on the interior insurance, but master policy to cover the exterior of the building, we're seeing major increases in those. And single family and multi-unit, duplex to fourplex, we're seeing really big increases on those. So basically any insurance policy that covers a roof, we're seeing 50 to 100% increases on an annual basis. It's staggering.
Yeah, one of the things we saw in the commercial landscape over the last couple of years is, like you mentioned, Joe, a huge rise in insurance increases. I know that State Farm, I believe this is nationwide, they're no longer insuring any multifamily properties that are older than 1970, which is a lot of the value add product that operators are going for. The 70s and 80s vintage, even stuff that's older than the 70s in some of these older markets. So clearly insurers are starting to see these properties at much greater risk, and they're just stopping insuring them altogether. So, I have seen a little bit of fluctuation, some decline on the commercial side, just a little bit, depending on which insurer you go to. Maybe it's not State Farm or Allstate or whoever, one of the bigger insurers, but maybe it's a local insurer that hasn't actually written a lot of losses like the big insurers have. That's where I've seen some of the most impact is if you go to a local insurer. For example, we went to one on our building and got about a $900 a month decrease. And I asked them, I was like, I don't understand it, because everybody else that we talked to, they're giving us $1,000 a unit, but you're giving us, 550, 600 a unit. It was a local insurer, and the reality was they could get more aggressive on pricing because they haven't written as much in losses as a lot of the big insurers have. And so I found that to be interesting. It was more of just a luck of the draw scenario. But, like you said, Joe, earlier, it helps to talk to, maybe it's not 3 insurers anymore. Maybe it's 5 or 6 insurers. It probably pays to make a couple extra calls because you never know which one will get you the rate you're looking for.
That's right.
Yeah.
Good question. Thank you, Jorge.
Any others that we should talk about?
I got a question for you guys. It's funny because going back to 2023, it was, rates will, you look at all the experts at Wall Street, the rates are going to get better in 2024. Oh, we just got to survive until 25. Now here we are in 2025, nothing's changed. And I think there's no sign of things changing for the rest of the year. There's some speculation that the Fed will maybe cut rates towards the end of the year, but I don't really know what reason they have to do it. What do you think 2026 and 7? I know get out your crystal ball is hard to answer, but I don't see a world where rates are going to have a significant decline anytime in the next couple of years. And I just don't see where the market fundamentals point in that direction. I think we're going to be here for a pretty long time. When I say pretty long time, maybe even the next 3 to 5 years. Do you guys feel similar about that, or do you think we might see a meaningful change?
Lon, you want to go first, or you want me to go?
For mortgage rates for houses?
Yeah. Yep.
Well, the U.S. credit rating just got downgraded by, I think it was Moody's about a month ago. So, I mean, Canada has a better credit rating than we do, which means they should be able to borrow cheaper than we can. Norway with, 6 million people has got a better credit rating than we do. So, the decrease in our credit rating is just like a person having a lower credit score. They can't borrow as cheap and they can't borrow as much.
Mm-hmm.
So, the mortgage rate is really indexed to the 10-year treasury plus a risk premium. So with that bottom number of the 10-year treasury is going to be static or increasing because of the credit decline. That's going to hurt us. It looks like we're on the verge of passing a tax bill that's going to have very large deficits over the next couple of years. So we're not the only industrialized country that's running larger deficits than historical, which means there's this tsunami of government debt that's got to be absorbed by all these investors. And if there's a lot more supply and demand is relatively static, that means that you've got to sell the product at less of a
Mhm.
price, i.e., offer a higher interest rate to induce people to want to come. So those two things are structural, and I don't see those really changing a whole lot. So if anything, I think you got more risk of rates going up than down over the next
Mm.
5 years.
Yeah.
I completely agree with that. Lon explained it much better than I could. Good job, Lon. But
Thanks.
I completely agree. I said earlier, I think we need to be prepared for 6.5 to 7.5% rates for the coming 6 months for the back half of 2025. And I think Lon's spot on. There's a lot more opportunity for rates to go up than there are for rates to go down. We might be sitting here in 2 years talking about, boy, remember how great it was when rates were at 7%? Now, do I think we're going to 10, 12%? No, I don't think so. But I certainly don't see anything that's going to make rates go to 3, 4%.
Yeah.
So I think higher for longer. I saw a headline recently. So be prepared for 7% for a long period of time.
Yep.
So we
Another.
showed that historical chart of the average mortgage rate by decade, and during the 70s, 80s, and 90s, the average mortgage rate was higher than 7%. And you got to reflect back during that 30-year period, we sold millions of houses every single year in an interest rate environment where the rates were higher than 7. So we're going to have some more hand wringing and like gnashing of teeth over the next couple of years as people adjust. But the reality is, like, we can sell a lot of houses at 7%. And we have in the past, and we will in the future.
Yep. Just outwork the market. If you're waiting for rates to go down before you're going to work hard, you're got that in the wrong order. Work hard, and then rates are going to do whatever they're going to do.
Right.
I got another question, but let's go to Imelda here. Do you have statistics on how many people are moving to Denver versus leaving the Denver metro area?
I haven't seen any hard stats on that recently, but the trend has definitely been that the amount of inbound migration has been declining, but the amount of outbound migration has been steady or increasing. So I think we've gone from where we've been adding net about 50,000 people per year in Colorado for a long time, and that really powered a lot of real estate gains to where it's probably closer to equilibrium, or maybe we're adding 10,000 people per year. So that definitely slows down appreciation in the market in addition to all the other factors that we talked about. Well, we're the most expensive non-coastal city in America for real estate by far.
Mhm.
So if you are a large employer and you're based in, I don't know, Boston, pick an expensive coastal market, and you're thinking about relocating, and your choices are I can go to Atlanta, Chicago, or Denver. Atlanta and Chicago, the prices are like half the price of what they are here. Atlanta's probably like a third less than Denver. It's a great quality of life here, but if your people can't afford to buy a $700,000 house on the salaries that you offer your company, like, it's just not a non-starter. So it's gonna be tough for us to attract employers, I think, in the future, given how high the real estate is.
Yeah. So I got a question for you, and Joe, you probably, I'm sure you could chime in too. You
Mhm.
guys have been longtime investors in Denver, right? So you go back to, Lon, I know you started buying in probably even before 2007,
But
but you
98,
started 98, yeah. So way before then, you went through the 2008 crisis, and then I'm sure you bought a lot too in 2010. If you look over the last 15 years, if you were a buy and hold investor, you've panned out very well. Bought at really low prices, rent has gone up, appreciation has skyrocketed. I know you're trying to sell a lot of your stuff in Denver now, but let's just say, pretend you're going to invest in Denver. How, if, has the strategy shifted since when you started buying to maybe today? If you're an investor wanting to buy in Denver, what is the expectation for you as an investor? What are some of the things that you're looking at? How does that strategy maybe shifted over the last 10 to 15 years?
well, that's a great question. So if you take a look over the last like 55 years, the average rate of appreciation has been about 6.5% a year for houses and maybe 5.5% a year for condos. So if you put 20% down and you make 6% appreciation, you've made 24% on your down payment, actually 30%. So if your cash flow break even with your principal pay down, the tax benefit that you get out of the depreciation write-off, and just the appreciation alone, you're looking in the mid 20s to low 30% rate of return annually, and you can make a huge amount of money over 10 to 15 years doing that.
Yeah.
Um, So why did we have such great appreciation here? Because it was relatively hard to build. There was a lot of construction constraints, and we had net 50,000 people here moving here, which is what Imelda is getting to. So we just talked about all these different reasons why we think the rate of appreciation is going to be slower or non-existent over the next couple of years, and you've got really high interest rates. So I don't think you're going to see much appreciation over the next 5 years. So that's gone. The prices are so high, I can't get most properties to cash flow. So really, there's not a model for me to be an investor here anymore. It makes more sense for me to take the capital somewhere else, to Tennessee, South Carolina, Florida, Arizona, places like that, Texas. If I had to invest here, what I would look at is, fix and flips, or fix, rent for a year, and then sell, so I could get capital gains tax treatment. That's always been a timeless strategy that works great. It's a lot of work, but even in a flat market, you can make a ton of money doing that. So that'd probably be what I'd look at. But I don't know, Joe, what would you look at?
I agree 100%. I still own 4 rentals in the Denver area, and I'm not looking to sell them, but I'm also not looking to buy more right now. I think there's a lot more opportunities. And here's the thing: I don't know anything about Nashville. I don't know anything about Florida. I don't know anything. I don't even know. I couldn't find Louisiana on a map. So you know what I do is the money that I want to invest for the long term, I hand it over to Nick and Lon and say, you guys go find where Louisiana is and please get me a return. So I have completely shifted to passive investing. If a deal happens to fall in my lap and it meets my buying criteria, I would be happy to look at it. But my buying criteria does not work in Denver right now. And that's okay. And it's not that Denver's bad. I think Denver's a great place. I think we're going to continue to be a great real estate market. For me personally, passive investing, and this was not an advertisement for why you should invest with Ironton. It's just to answer your question. That's what I do. All right. Well, guys, thank you as always. Lon, great information. I love some of the new slides. This was super educational as always.
Yep.
Thanks for joining me, guys. I really appreciate it. Thank you for all of our viewers.
Awesome. We really appreciate you all being here. This recording and the presentation will all go out. Should be immediately after the webinar. But if you guys have any questions or just want to chat, brainstorm some ideas, feel free to reach out to us. We love this stuff. So we're happy to talk for as long and however many times you like. So feel free to use us in any way. We can be a resource, and we will see you all next month.
Thanks, guys.
Thanks, everybody.
Thank you, guys.
Appreciate it.